Okay, guys, we did a recap video of March, and the markets were up a lot. NASDAQ was up almost 7%. S&P was up 3.5%. So as you know, if you're new to this channel, I want you to subscribe, and here's why. When things feel their best, when markets are up, I'm more cautious. But when things are down and things are falling, I'm more optimistic. So this is very important that you follow the channel and you share this video with other people, because I will be the person saying things are a great buy when everybody thinks it's a terrible world out there. Go look at my videos from early 2021. We've done over 2,000 videos. When stocks were flying high, I said, this is crazy. And people were like, you are so dumb, you don't get it. And then all of a sudden, all the crap talking stopped. Now, we're not even close to done with this bear market. I truly believe that we are in the early stages of a very bad bear market. Why is that? Valuation. Guys, the single most reliable metric in the stock market at any given time, according to Warren Buffett, is the stock market to GDP ratio. What this does is it takes the entire stock market market cap, and divides it by US GDP. That, if you go back in history, it's correlations of like 0.8, 0.82 on a scale of -1 to 1. That's a very strong correlation. Now, I made my own based on the S&P 500. And this is what it says right now. We are currently 68.7% overvalued. This is a chart of history on valuations. When you're at 0.5, your potential return over the next 10 years is very high. When you're at very high valuations, your returns are very low. We're all the way over here right now. Because look, we're currently at 1.571. We're currently right about here. So the future 10-year returns are very, very ugly. If you look at our history, when we're over 50% overvalued or more, the next 10 years averages a negative 0.5%, not including dividends. So with dividends, you could probably still make some money. Now, is this set in stone? No. However, this is pretty reliable here. You look at this path here. Could we end up with some better returns than I'm projecting? Absolutely. If GDP still skyrockets, GDP is driven by inflation. The higher inflation is, the more GDP rises. So when you have a stock market to GDP ratio, the more the denominator goes up, the better for the entire ratio. But we go back to 1929. 68.7% overvalued. Let's put this in perspective. The 2000 tech bubble never hit these levels. Look at these numbers back in the 2000 tech bubble. The highest we got was 56.9% overvalued. We're at 65%, 68.7% after falling a ton last year. It got as high as 103. Guys, I said in other videos, go look at my videos from 2021. I said this is the most overpriced market in history, worse than the tech bubble. And people said, you're crazy, you don't get it. Because in the middle of it all, when stocks are going up, it feels so easy. It feels so good. Why would you fight that? I'm not a fudster. I'm not here to put fear, uncertainty, and doubt. Because if tomorrow the S&P went to 1750, from 4,100, you know what I'd be saying? Great time to buy. You're going to do very well. There are going to be fluctuations along the way, but if you're buying at these levels, you're going to do very well. We did videos on Google. When Google was at 150, and I said, I'm interested in Google under 100. You're never going to see Google under 100. Go look at the chart on Google in the last year. It's been under 100 several times. It might currently be under 100. So, and guess what we're doing? We're selling puts to buy Google. That's what I'm saying, guys. You have to look at buying individual stocks as buying pieces of businesses. And you have to look at the profit potential in the next 5, 10, 20 years and say, can I buy it for a reasonable price? But most importantly, and this is why you need to subscribe to the channel right now, you need to have the emotional fortitude to be able to look at a stock that's fallen 50% on you and say, my fundamental beliefs in the company and their valuation are still the same. Nothing has drastically changed the profitability. But that's about understanding the company. We looked at a company this weekend. I'm not going to get into it because it's too small for us to talk about individually on this company. But this company is a very cyclical business. It relies on a strong economy. So even though last year the company made a lot of money, I did not value the company based on last year's prices. Why? And profit. Why? Because it's not reasonable. This is a booming economy. If you look at their history, every time there's a booming economy, their profit falls thereafter. by significant amounts. So I have to normalize their profit. And that's the same thing I'm doing when it comes to the overall market. That's what you do in this ratio. You're looking at the stock market relative to the entire US economy. Are there arguments about why we're not this far? Well, of course, there's always arguments. I could probably find arguments as to why we're worse overvalued than we are before. But if you look at the 10-year cyclically adjusted PE ratio, it only cares about profit. It's at 28. Historical average is 17. Look. That shows how much percent overvalued, 60, 70% overvalued, if not more, 11 out of 17. The same ratio. So again, am I trying to put fear in your, no. But if you're close to retirement, you need to, and you have 100% of your money or a large percentage of your money in stocks, you need to understand that there could be a lot of volatility coming. Are you okay with that? But if you're young with decades to go for retirement, you have one thing to do only. The market's going to do this over time. In value, this is going to be the prices. You need to just keep buying over and over and over again. And we will have times when the market's undervalued. And if you have the ability to put more money in at these points, you are going to crush the market. The hard part is the emotional side of doing it. And that's why you need to subscribe to this channel. We will be the only people who are probably talking about what great times it is to buy. All those other idiots out there, those financial gurus out there who just bought one stock, it went up, and they thought they were great. They are going to go to the wayside. They're going to find something else to talk about when everybody calls them out in their BS. The Stock Mo's, the Tom Nash's, the Andre Gieks, all these idiots out there. When crypto goes under, I believe it just has to happen. Crypto to me is the poster child of this overpriced market. It is an asset that has no bearing on reality or valuation, and I don't care about the technology. You don't need a cryptocurrency to have technology. That's like saying you have to have a business to have the internet. The internet can exist without a business being there. It can. Now, has it? No, because people found a great way to make money off the internet. But it's like saying you couldn't have the World Wide Web. In 1991, 1992, when there was World Wide Web, there were no internet websites. There was no Amazon. I'm sure you could still buy things on the internet, but give me a break. So guys, if this makes sense to you, subscribe. If it doesn't make sense to you and you think I'm crazy, say below. It doesn't bother me one bit. Because when stocks do fall, I'm going to be dancing my way to the bank from all the positions I've created and all the ones that I'm buying at lower prices. And that's what's exciting to me. But if what I've said has made sense to you and you believe in the US economy long run, you should hope for lower prices. If you believe in Microsoft, Google, Apple, all these companies, you should hope for lower prices. But what's going to happen is this. Those stocks are going to fall and fall further, and then the stories are going to change because the stories that are reported always reflect where the stock has gone, not the fundamentals. And it'll be your job to be smart enough, which you can be because you've stayed long enough in this video, to be able to say, wait, this isn't rational. People are mispricing the stock, and that's what you're going to be able to do by subscribing. Thank you very much for your time.